Hello everyone. In this lecture I am going to discuss the journal entries of income. It means we have to study the rules of debit and credit and journal entries for income. And there are three cases of income, students. Please listen it carefully. Income, journal entries for income we have to discuss. The first case is income received in cash. Second is income earned but not yet received. And third one is income received in advance. And we have to discuss journal entries in all these three cases. And after this lecture, you will be able to pass any journal entries relating to the income. So the first case is income received in cash. See this, students. Income is a nominal account, you must understand. For example, income, that is interest. Interest is our income. Interest received in cash, rupees 5,100. See, this is the case. So there are two accounts, because in every financial transaction there are two accounts. So in this case, the first account is cash and second is interest. See this, students, carefully. Cash is a real account, you must know this. Cash is a real account. Debit what comes in, credit what goes out. Otherwise also keep this in always mind that whenever there is a cash transaction, your focus should be on cash. Then it will be easier to pass journal entry for you, because if cash is coming in, we are receiving cash, it is of course debited. Real account, debit what comes in. Asset is increasing. And second one is interest. Interest is what? This is our income. See, cash is our asset, it is increasing, so real account, it will be debited. And second is interest. Interest is our income, and income belongs to nominal account, dear friends. Nominal account. And what is the rule of nominal account? Debit all expenses and losses and credit all income and gains. So it is an income, therefore it will be credited. So journal entry for income received in cash, that will be cash account debit, which you need to pass in the format, proper format, 5,100, sorry, to interest account. So this is the journal entry for first part of income, which is received in cash. On the one hand, cash is increasing, real account, debit what comes in. Secondly, interest is an income, so it is a nominal account, and according to the nominal account, credit all income and gains. So this is the journal entry. Now come to the second case, very important one, income earned. Income earned means we are entitled to claim that income. That is our income. On that part, we are entitled to claim, but not yet received, not yet received in cash. It means that is our income. We have earned that, but not received in cash in the current accounting year. And this is called accrued income, friends. ACCRUED, accrued income. And accrued income is what? Simply, it is an asset, friends. Asset. Anything which is to be received by the business in future, that form the part of asset. It means that is an increase in the asset. And whenever asset increase, this is always debited. So there are two accounts in this transaction. First is accrued income and second is income. Second is income. Income is what? This is a nominal account. This is a nominal account. And according to the nominal account, credit all income and gains. So it will be credited. You need to understand, simultaneously, we are using two approaches of rules of debit and credit. One is the traditional approach and second is the modern approach. This is the traditional approach. nominal account credit all income and gains. And this is the modern approach. Increase in asset is debited and decrease in asset is credited. In order to pass journal entries while outstanding expenses take place, prepaid expenses take place, accrued income, unearned income, we need to use the modern approach of accounting, modern approach of rules and debit and credit to understand these journal entries. So suppose it is interest rupees 5100 earned but not yet received. In that case, our journal entry will be accrued interest account debit, accrued interest account debit, suppose the same amount 5100 to interest account 5100. So dear friends, accrued income is an asset. It has been debited since it is showing an increase in the asset according to the modern approach. And to interest account, this is income. And whenever income increase, that is also credited. So this is the second case of accrued income, means income earned but not yet received. Now the third case, very interesting, income received in advance. It means we have not yet worked for that income, but we received that in advance. It means that is not our income of the current year, and that is not part of our current year income, but we have received it. It means there is an increase in cash. The first is the cash account, cash increase, and whenever cash increase, it is always debited. And second account is what? Income received in advance. It means income received but not yet earned. We have not yet earned it. We have not worked for it. So this is second account will be unearned income. Unearned income. See friends. And according to the modern approach, unearned income is what? This is our liability. Liability. Why it is our liability? If we don't work for this income, we have to return this. Understand? If we have not worked for it in the future also, then we need to return that amount. So since till the time we don't work for it, that remains our liability, and liability according to the modern approach is always credited, friends. So our journal entries will be, there are two cases. According to the first case, at the time of receipt, if we know this is our unearned income, we pass this entry, cash account debit. Suppose the unearned income is interest, we will write here to unearned interest account, to unearned interest account. Suppose amount is same, 5100, 5100. Suppose at the time of receipt, if it is clear that this is our unearned income, we pass this direct journal entry, cash account debit to unearned interest account. But sometime at the time of receipt of the income, what we do, we treat that as income. And while preparing the financial statements, we make adjustment for that. If an adjustment entry is required to be passed, in that case, this will be the journal entry, friends. Interest account debit, interest account debit to unearned interest account. This is the alternative journal entry, friends. I tell you justification for it. Try to understand. Interest debited, it doesn't mean it is an expense, no, because at the time of receipt it was credited, but this does not belong to the current year income. So that part of income which is credited, but that is not part of our current income, in order to cancel that, it is debited. In order to neutralize the effect of that income, it is debited, and unearned interest, this is our liability, and liability is always credited. So friends, just watch the video properly, listen each and every point properly. In that case, you will be able to pass any journal entries relating to income received in cash, income earned but not yet received, and income received in advance, which is also termed as unearned income. I think the concept is clear to you. Share the video with your friends and classmates and subscribe the channel if not yet subscribed.